Hello, I'm Fenton Burgin, head of Deloitte's UK Debt Advisory team. The political result of the UK's Brexit referendum is still being felt, but the subsequent debt market adjustment has so far been relatively orderly. It's clear that European financial markets are likely to suffer an extended period of volatility over the summer months, with sterling facing continued pressure. But currently, no London-based banks or alternative lenders are envisaging a full market shutdown in either the leveraged finance or the corporate lending sectors. Also, so far post the referendum vote, there's been no spike in European interbank rates, and the Bank of England has moved very quickly to provide support through easing regulatory restraints in a push to free up at least 150 billion sterling of liquidity. More broadly, the odds of the Federal Reserve raising borrowing costs this year have much reduced, and with investors piling into the perceived safety of government bonds, we look set to be operating with ultra-low interest rates well into 2017. But despite these low rates, I don't see a big pickup in refinancing activity, and the European loan markets are going to have a tough second half. First half issuance was already at a 12-year low of $368 billion, down 31% on the first 6 months of last year, with refinancing, normally a big driver of total volumes, down 56%. Basically, most European companies have already refinanced in the last couple of years at low rates, and M&A-driven financing was down 31% in the first half to $74 billion, reflecting concerns around the pace of economic recovery and a slowdown in China. Will funds and alternative lenders remain open for business? Yes is the answer. While some global asset managers may refocus away from Europe on higher growth and lower risk markets, record levels of direct lending capital have been raised over the last 18 months, and with Treasury and gilt yields falling, I think investors will likely remain keen to deploy capital into the European mid-market where rates are higher. I see continued low activity in the big-ticket M&A markets, actually propping up liquidity in the mid-market where yields are higher and deals can be financed without the need for investment bank underwriting. More broadly, the Brexit vote is likely to really accelerate the shift from banks to direct lending funds in the UK leveraged finance mid-market, as some European banks refocus on domestic markets as opposed to pure UK deals, and UK lenders face higher funding costs. Additionally, with high yield and IPO markets looking uncertain, I anticipate direct lenders continuing to lend, with a number now being able to advance up to 200 million sterling on any one deal. So what do I see happening to loan pricing? Whilst UK banks and funds remain open for business, as a minimum the potential remains for a Brexit vote impact to feed through to UK corporate borrowing costs. Investment grade borrowers are likely to be largely unaffected by the vote, seeing some limited pricing uplifts on bonds and loans, more than compensated for by falling benchmark yields. But some mid-market, purely UK borrowers could face limited pricing increases on their loans and more restricted access to bond markets, subject to currency, sector and issue size. What about the high-yield bond markets? Well, they're likely to remain volatile and uncertain, particularly for sterling issuers. Post the referendum result, higher risk assets saw large capital outflows as investors redeployed money into government bonds, US dollars, Japanese yen and other so-called safe haven assets. In leveraged loans, volume in Europe reached just $68 billion in the first half, a drop of 47% on 2015, and the lowest first half volume since 2010. Even though the debt markets are open, the key question is whether sellers will sell and buyers buy in this market. Right now, the market's working through a pipeline built up over the last 6 months. I think leveraged loan structures are likely to be more conservative going forwards, and lenders are likely to either flat out decline or to seek a large risk premium for any business opportunity that could be impacted by Brexit, such as companies operating in the airlines, travel, retail, consumer and house building sectors. Essentially, you'll see a flight to quality, and few leveraged finance teams are going to push the envelope on structures in this market. Turning to foreign exchange and Treasury issues, sterling is at its lowest level against the dollar since the mid-1980s, although against the euro it's close to its 5-year average. With respect to Treasury management, the main Brexit impact will be felt through material swings in FX rates and resulting volatility to financial results. Whilst most of the damage will have been done, corporate hedging practices will need to be updated, looking at current target FX rates or hedging ratios that may be unrealistic. Additionally, the profile of FX cash flows may change as the makeup of customers and suppliers by geography changes. A need for increased levels of hedging could mean the need for increased credit lines, and treasurers will have to stay close to their cash flow forecasting and actual cash conversion to manage liquidity. In conclusion, the markets look set to remain volatile over the summer months, and if you have an impending financing or treasury exercise, the arguments in favour of moving it forward sooner rather than later are compelling. Thank you for your time, and I look forward to speaking to you again in the autumn.